Hey, welcome to the channel. This is the second episode of Accountancy Basics. We're going to cover financial statements. If you enjoyed the video, feel free to give it a thumbs up, subscribe, and check out the rest of the playlist. So let's get into it. So in this video we're going to go over financial statements. We're going to explain exactly what they are, what they're used for, and also I'm going to give you a brief explanation of how each of them works. So there are four key financial statements that are commonly used throughout business. The first one is the statement of financial position, which is also known as a balance sheet. A statement of profit and loss and other comprehensive income, which is also known as a P&L or an income statement. And the final two are less used than the first two, but they are the statement of changes in equity and the statement of cash flows. So what are they used for? So the balance sheet and the profit and loss are the most common financial statements used by management to assess how a business is doing. They're also required in the majority of statutory accounts that are submitted to Companies House at the end of the company's year end. For bigger companies that require more detailed accounts to be submitted, you also need to include the statement of changes in equity and the statement of cash flows. However, they're not very commonly used by management to assess how the business is doing, unless... No, they're not. No. As well as statutory reporting, they're also used by management to make business decisions. So being able to see your assets and liabilities as well as the profit you're making is really key to understand the next steps that you should take as a business. They're also a really good indicator of how healthy the business is and whether the business can keep running in the long term. Additionally, investors usually ask for the financial statements so that they can determine whether they want to invest in the company or not. So I'm going to now give you a brief explanation of how each of these statements work, and I'm also going to try and include a snapshot of what it looks like around about here. So the statement of financial position, also known as the balance sheet or the SOFP, it's made of three key sections. At the top you have your assets, then you have your liabilities, and then you have your equity. Now this goes back to the accounting equation. If you watched my video on debits and credits, we discussed the accounting equation is made up of assets equals liabilities plus equity. So the balance sheet just summarizes this and shows you a breakdown of what's under each category. So if you see there's a total underneath the assets for total assets, and there's also a total for the liabilities and equity, but there's also a total for the liabilities plus the equity. And as you can see, both of these match. This is a really good indication as to how the accounting equation works, and it also shows any imbalances if the two totals don't match. The next financial statement I want to talk about is the statement of profit, loss and other comprehensive income, also known as the income statement or the SPLOCI. So at the top you have your revenue and any other revenue. Revenue is just money generated by the company through normal trading. Other income is any other sort of income generated that may not be from business activity. This could include bank interest or rental income if you own a building that you're renting out while not using it. Then you go on to your expenses. The expenses are split into two types. There's cost of sales and there's your operating expenses. So cost of sales are expenses that are generally incurred in order to provide the service that generates your income. So if you were a shop that sells t-shirts or merchandise, your cost of sales would include printing costs to print on t-shirts and also the material costs for buying in the t-shirts. The operating expenses is everything else, essentially. So this includes your rent, your rates, your salaries and other types of expenses that are normally incurred in the course of business. Other comprehensive income is a little complicated and it's not usually found on most profit and losses, but this is usually where extraordinary items are kept, such as gains on property revaluation, but this isn't something that I'm going to cover in this series. This is a bit more advanced. The statement of cash flows is essentially a summary of the movement of cash through a given period. You calculate it by looking at the movements in aged payables, aged receivables, and other asset accounts. I'll do another video detailing how to create one, but for the purposes of this video, I just want to give you an idea of how it works at a high level. Finally, the statement of changes in equity is essentially what it says on the tin. It shows you the balance at the start of the period, the different movements which could be from dividends or shareholder contributions, and then the final balance. This essentially just gives you a reconciliation of all of the movements that total the final balance in our balance sheet. So I wouldn't particularly worry about the statement of cash flows or the statement of changes in equity, as they're only usually needed for big statutory accounts work and aren't usually required by management when they want to see how the business is doing. The key ones to know and understand are the balance sheet and the profit and loss. And I'm going to cover these in another video as well. I know this was a super brief video, but I just wanted to kind of give you an overview of financial statements, what they were and what they're used for, as well as a brief explanation, just so that when I go on to do videos explaining each of these in detail, you're not going in completely cold. If you enjoyed the video, please give it a like. I would love it if you could subscribe, and I'll see you on the next one.